Australia's economy is slowing to a multi-decade crawl. New analysis says growth will stay below 2% for the longest stretch in 30 years. Deloitte Access Economics expects just 1.3% growth this year, and only 1.9% in 2027 to 28. That is the weakest sustained pace since the early 1990s recession. The problem is not just demand, it is supply. Years of weak productivity, underinvestment in housing, infrastructure, energy, and capacity have left the economy fragile. Recent business investment has been dominated by data centers, but much of the equipment is imported, so the near-term boost to the real economy is smaller than the headline numbers suggest. Inflation is also proving sticky. Core inflation is running at 3.6%. That is the second highest among major advanced economies. Deloitte sees it peaking near 3.9%, well above the RBA's 2 to 3% target band. The forecast is for another rate hike in August, taking the cash rate to 4.6%. Then a pause for a year. Markets are less certain, but still pricing in a meaningful chance of more tightening. For households, the pain is acute. New KPMG analysis shows interest payments as a share of income at record levels. In the March 2026 quarter, households paid $33.6 billion in interest on mortgages and consumer loans. That is the fourth highest on record. And the interest-to-income ratio has climbed back to 5.4%, higher than during the 17.5% rate era of 1989-90. Back then, the peak ratio was 5.7%. In the years around the global financial crisis, some Gen X households hit 7.9%. But today's burden is broader. It is spread across more households and loan types. And it is happening while living costs remain elevated. Treasurer Jim Chalmers points to low unemployment, smaller deficits, and tax cuts. But HSBC warns that a housing slowdown could cut inflation at the cost of weaker consumption and construction. The bottom line is clear. Australia is stuck in a low-growth, high-cost regime. Productivity and investment must improve, or the next decade will feel a lot like this one,